Hey, welcome back, subscribers, to my world of stocks, and welcome back to another episode of our institutional buyer series, where every weekend we cover some of the biggest stock purchases being made by the absolute largest market movers in the world. And today we've got over $2 billion spent by the infamous BlackRock on just three stocks alone. All three of which, by the way, not only have fantastic businesses, but they're each going through some decent sized dips right now, too. So I'll let you know whether I agree or disagree with each purchase. And to make things even more fun, I'll be giving each stock my own personal grading too, ranging from strong buy all the way to strong sell. So let's go ahead and jump into it. Let's start first with the smallest purchase. And here we have the snack and beverage giant PepsiCo, ticker symbol PEP, which BlackRock just picked up another $41 million of last quarter, bringing their stake up to more than $18 billion in total. And yeah, this one is actually looking like a fantastic pickup. Not only is this a global leader in drinks, but just as important is their Frito-Lay division that quietly is becoming really a snacks empire. In fact, most people don't even know this, but it's actually their snacks business that drives about 60% of the company's entire operating profit. How crazy is that? And because people usually cut back on higher price purchases first whenever the economy struggles, well, their business has become a cash cow because it's usually lower price goods. And long term, really, it's become an investor's dream for passive income. Pepsi has now grown their dividend every single year for more than 5 decades in a row, allowing investors to collect those really nice yields basically all the time. And yet, even though consumer staples are usually a pretty safe place to park money, PepsiCo stock has actually taken a beating more recently, falling about 30% from the highs, even leaving it negative over the past 5 years. That's kind of interesting. Almost never really falls like that, but to be negative in 5 years is a pretty big deal. And that's really due to the fear being that cash strapped consumers will push back against higher prices given all the inflation. But management has actually implemented several strategic price reductions where possible along their products line, for which we're already seeing their sales volume start to tick back up. Plus, the company is so large that they've been able to adjust to changing consumer trends with numerous acquisitions like Poppy, or even new product launches in house like Doritos Protein and Pepsi Prebiotic, which analysts project will help drive new growth on both the top and bottom line to continue breaking new record highs as they usually do. But because the stock has already fallen by so much, well, we're now getting a rare discount on what has always been one of the best performing consumer giants on the market, with a forward P ratio that now sits pretty close to the same level as the sector and a whopping 26% lower than their own 5 year average. And best of all, it's caused the dividend yield to spike up to above 4%, which is a level we almost never see in their entire history. I do already own PepsiCo stock myself, and I would buy more at these levels here all day. So I, of course, agree with BlackRock purchasing here, and I would grade it at least a buy. And I'm even leaning a little more towards a strong buy grading too. All right, up next, though, is one of the most popular AI stocks that actually just fell on earnings for stock number 2 here. But first, I want to take a quick moment to thank today's video sponsor, FSA Store. As some of you know, I love playing basketball several times a week, but to be honest, after many high intensity games, my knees take an absolute beating. And instead of just pushing through the soreness, I've completely upgraded my post game recovery routine thanks to FSA Store, who sent me this heated knee massager that has been an absolute game changer for my recovery routine. It's the perfect example of how you can level up your recovery using your pre-tax FSA dollars. And what's crazy is that a lot of people think flexible spending accounts are just for basic drugstore bandages or prescriptions. But FSA Store is actually the largest online marketplace dedicated entirely to products that are guaranteed 100% eligible. So you can pick up advanced recovery tools, pain relieving massage guns, and red light therapy completely tax free. The best part is that shopping there is completely hassle free too. With over 2,500 items on the site, if it's there, it's guaranteed eligible. You can use your FSA card right at checkout, where there's no hassle of submitting receipts or crossing your fingers for approval later. So, if you want to maximize your hard earned money and step up your own recovery game, then stop leaving your pre tax funds on the table. Go to fsastore.com/ale, ALE, or scan the QR code right here on the screen to start shopping today. And huge thanks to FSA Store, where everything's eligible, for sponsoring this video. Thank you. All right, guys, jumping back into it here for purchase number 2. Well, we have Broadcom, ticker symbol AVGO, which BlackRock went absolutely crazy on, gobbling up a staggering $2 billion worth just in the past quarter alone, bringing the stake up to about $120 billion in total. That's a crazy purchase there. Now, we'll get into the earnings here in just a second when looking at Broadcom. But when it comes to the company here, everyone knows that NVIDIA is they've really become the king of like general purpose GPUs, right? But something that's happening right now in a little bit of like in the background is that mega cap hyperscalers like Amazon, Google, or even Meta are increasingly shifting towards custom AI chips too to help lower their data center costs and get more flexibility. Well, Broadcom happens to be the undisputed leader in helping these giants design those custom chips, what we call ASICs, ASIC. In fact, Broadcom already has custom chip deals locked in with Alphabet through 2031, Meta through 2029, and they're even partnering with OpenAI and Anthropic too. Because of this, their AI chips revenue actually soared by 143% last quarter, up to nearly $11 billion. Management is even projecting to hit $16 billion in the next quarter too, which, by the way, would be up around 200%. It's freaking crazy how on fire this business is really becoming. And yet, if we pull up the stock chart, you'll see that the stock actually sunk today. Now, I'm recording this midweek and it'll get uploaded on the weekend, so the numbers might change by then. But as of right now, Broadcom stock is actually down about a fifth of its value from its recent highs. Now, to be clear, this is still a phenomenal performer overall when you zoom out a little. And because of it, the recent dip, in my opinion, is actually more to do with investors just taking profits than anything else. And while that AI forecast wasn't quite as high as the market wanted, despite being super impressive regardless, and while management did guide for slightly lower gross margins next quarter, dropping from 77% down to 74%, it's really just a small excuse that I think the market is using to be able to lock in profits. Because in reality, their AI chips business is just growing so fast that it's artificially kind of weakening their margins, I'd say, because they aren't as high as their traditional networking products that don't have the same explosive growth. So as you grow more in the AI chips business that is a little lower margin, it hurts your overall margins. But yeah, that's like that. I mean, guys, that's a very good problem to have. And it's not at all reason to be selling the stock, in my opinion. It's actually reason to be optimistic about everything that they're doing for the future. In fact, their financials are growing so fast that with the recent stock dip, their valuation is actually a giant 45% lower than the sector median on a PEG ratio basis. And while they've never been much of an income play, well, their small dividend does at least carry some fantastic growth metrics on it, like a double-digit growth history and rate with a very small payout ratio. And yet this might surprise you, but I actually disagree with the purchase here by BlackRock, but it's only very slightly, and it's not because I don't love the stock. I actually own Broadcom myself, but I just think it's more of a hold after the big run up where it's already been up. It's already risen by over 700% in just the past 5 years. I'm up a ton on my position too, and I'm not personally buying any more at this time, but I'm definitely not selling either. It's just a very long-term hold for me. And if I didn't already own it, then yeah, I would actually upgrade that rating to a buy rating because I do want to have some of it in my portfolio for the future of custom silicon, regardless of what's going on here. So yeah, that's just how I feel about it. But hey, that's going to bring us now, guys, to purchase number 3. And here we have one of my all-time favorites that I am ecstatic to see BlackRock loading up on shares too, because it's one of my largest positions. And that is the e-commerce and cloud computing and AI juggernaut, really, Amazon, ticker symbol AMZN, which BlackRock recently added another $265 million of bringing their stake up to more than like 150 billion in total now. What a mind-blowing amount. But it makes total sense why. I mean, now investing in Amazon these days, I would really call it like a tale of two businesses with a ton of side projects kind of sprinkled throughout to make this one of the most compelling options for investors in the entire market. Most people, of course, do focus only though on the e-commerce side, which may not sound as exciting as all of the growth to be had in artificial intelligence. But the truth is that Amazon has such a giant stronghold on the e-commerce market at this point that I actually think it's in a perfect setup here for nothing but huge profit growth down the road, especially in how it's being leveraged for high margin advertising too, as more companies are going to be competing for eyeballs on Amazon.com to sell their products. It's really just a phenomenal position that they're in, and I only just see it becoming even stronger over time. And when it comes to AWS, Amazon Web Services, the cloud division, well, even though it brings in less revenue than the retail side, it actually produces nearly 60% of the company's entire operating profit. So it's yeah, it's just as important. And with AI demand soaring, well, the cloud platform has already grown to a mind-boggling $150 billion annual revenue run rate. That's pretty crazy. And as a whole, the numbers get much scarier than that. Last year alone, for example, Amazon generated over $700 billion in sales, and that was still up double digits. And they also brought in close to 80 billion of pure net income profit, and that was up over 30% year over year too. So it's just absolutely on fire. Yet when you look at the stock chart, Amazon has, in my opinion, been heavily suppressed for years now. It just doesn't make any sense when you look at the financials. It's only up actually around 38% in the past 5 years, less than 40%, while the broader market has ripped much higher. And it's even down about 15% from the top two. And that's leaving their PEG ratio at a shocking 12% discount to the sector median. And this is a clear disconnect from reality. Amazon should never be trading below sector values. They're a very clear and dominant leader with a cash cow business and still tons of future growth potential as they continue to enter and expand further in new markets like pharmacy. You've probably been, shopping on Amazon. You see all those ads and promotions to start buying your pharmaceuticals through Amazon. There's giant potential there. Of course, there's Prime Video. There's also music too. But video is really a bigger one. So video streaming, they're doing stuff with robo taxis, autonomous driving, robotics. There's even semiconductors. They're like designing their own chips now too. So there's just a lot going on with Amazon, and they've got more on the way too. I promise you that it's not going to be stopping with them anytime soon. They're just going to keep expanding into new markets slowly, little by little, and then before you know it, they're like dominating many of them. So yes, of course, I agree with this purchase here by BlackRock. Amazon is the definition of a set it and forget it type of stock that I am almost always willing to buy, but especially on a discount like this. And I would grade it a strong buy because of it. But hey, there you have it, guys. 3 of BlackRock's biggest recent purchases. Overall, I like the pickups. I think you've got an ultra safe defensive play in PepsiCo, an aggressive play in custom AI chips with Broadcom, and an overall just kind of juggernaut for just about anything you'd want with Amazon. So yeah, I'm all for it. I would like to hear what you guys think about these moves down below, though, and let me know too if you own any of these stocks and whether you agree or disagree with my gradings on them too. But hey, either way, I hope you enjoyed the video. I thank you so much for stopping by. Got more videos coming for you soon, so stay tuned. I'll catch you guys in the next one. Hope you're all doing well. Take care, my friends. Bye-bye.